some of the most painful financial decisions that can haunt you throughout the rest of your retirement. Plus, we also need to finish up a conversation we started last week about some of the new rules that folks are going to have to follow if they have anything to do with trading of cryptocurrencies or Bitcoins or anything like that. We started the conversation and kind of ran out of time, so we want to make sure that we cover that on this week's program. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Coming to you here on Sunday mornings from the News Radio WFLA Orlando Network, along with 96.9 The Game. Also, our program happens to be one of the top 25 financial planning podcasts on the World Wide Web, with over 12,000 downloads to date. So my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. Our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So before we get to those topics that we talked about at the top of the program, here we are. It's October, which means that we're in Q4, the fourth quarter of 2020. I don't know about you, but I'm glad we're here. That means we only got one more quarter of this year to get through, and then we'll put this one behind us. I'm sure there's a lot of folks out there that share that sentiment, and certainly a crazy year with a lot of unbelievable events, just the impact of COVID, and then consequently the shutdowns that occurred as a result, and then the ripples economically that occurred from that. As we've said many times over the course of the past few months, those ripples, those economic ripples that were caused in the economic pond by the COVID rock that got thrown in the midst of all of it, are still out there, and they're still rippling on through. And I don't know that we've seen really the full impact or the full aspect of that. So the name of the game, I think, would continue to be understand that it's too certainly all early to call all clear, which is why the folks in Washington sort of picked up their debate this past week in terms of generating another stimulus package. Not sure how they're going to pay for it. That's like a whole different conversation that nobody wants to have right now. But ultimately, there certainly continues to be some ripples in the economy. If you look at your statements that would be coming to you on a quarterly basis, if you have investment accounts or 401ks or retirement accounts or anything like that, and maybe you get those monthly, but at the very least you should be getting those quarterly. So that means then that coming up probably this coming week, you would start to see those statements coming to you in the mail. And lo and behold, despite a relatively weak September where the market sort of started to drift downward, the third quarter of this year actually was relatively positive. Overall markets were up about 8%, give or take, for the quarter. The reality is that so far this year, the markets are actually positive about 3 or 4%. So surprising as that may be against that backdrop, the second and third quarter of this year were, in fact, the best 6-month performance for those 6 months, Q2, Q3. Markets were up a cumulative amount of 27%. That's the best 2 quarters since 2009. Of course, it's easy to set records like that because if you think of the last time that we saw that strong of a 6-month period of time, it was right after 2009. So that's coming out of a significant economic event, much like Q2, Q3 of this year. We're also coming out of a significant economic event. So some interesting numbers on that. That is for sure. In other news, you've got the Disney news that also broke this past week, obviously laying off a number of folks. I think the number I saw was 28,000. So we wanted to take a minute and specifically recognize the struggle that's going to cause for many Central Floridians, and encourage you to give us a call at the office this coming week if you're one of the folks that's been affected by that. If there's anything that you need assistance with, we're obviously here to help people navigate their finances, and there's nothing more dramatic in terms of one's finances than losing their job. So know that we are here to help you this coming week if you find yourself in that group of folks that is in the Disney layoff, or for that matter, any other company that's having to lay people off as a result of that. So know that we're here to help you if you need some guidance and assistance on navigating what certainly is one of those big life events, if you will, that that can occur and did occur for many folks this past week. So don't know if you saw some of the numbers, the latest numbers on housing. We've been sort of scattering some of the numbers in over the course of the past few weeks. It continues to be, in the residential real estate market, a situation of low supply and high demand. We'll give you a couple more numbers that we saw just this past week. The supply issue cannot be understated. There's 400,000 fewer homes for sale nationwide at the end of July than there were a year ago. So to put that into percentage terms, that's about a 20% drop in the number of available homes for sale nationwide from just a year ago. The high demand factor comes in with this statistic that says that 68% of the nearly 600,000 home sales that occurred in July happen with listings that were on the market for less than 30 days. So you got almost 2/3 at 68%, 2/3 of the house sales that happened in July of this past year. So we were in October, so the data is a couple months old, but still pretty relevant. Home sales, 2/3 of them in July of 2020 involved listings that were on the market for less than 30 days. So pretty dramatic stuff. On a similar note, new residential construction, over 139,000 new units were built in July of 2020. That is the highest monthly total record since September of 2006. So a lot going on in the real estate market, particularly on the residential side. The one caveat you have to be aware of is that if you are trying to refinance in light of these historically low interest rates, lenders are having a little bit of a problem trying to make money in this low interest rate environment. They're just not quite making enough if you're loaning money to people on a 30-year basis at 3.5%. So be aware that they've sort of figured out a way to maybe increase their bottom line, and that means that comes to you in the form of an additional fee or expense. So be aware, starting September the 1st, so it's already started, a homeowner that refinances may see an extra fee of 0.5% of the loan value. So on a $300,000 loan, that would be about $1,500 of an extra fee that you would see. That's not necessarily going to be lender directed. What happened is the folks at Fannie Mae, Freddie Mac, the largest mortgage providers in the country, the quasi-government entities that house those mortgages, are adding a fee of 0.5% to refinance loans that they purchase. Fannie and Freddie purchase mortgages across the country, bundle them together, sell mortgage-backed securities. They're adding a fee of 0.5% on mortgages that they purchase. So guess what happens when the Fannie and Freddie add a fee to lenders when they purchase loans? It gets passed on to you. So be aware of that. Double check to see if that fee applies. We're going to take a break. When we get back, we're going to continue the conversation a little bit about international investing coming up next here on the program Dollars and Cents with Joel Garris. So what are the some of the more painful decisions that you make that can very well haunt you well into your later years, whether that's your future retirement or wherever you're trying to plan. And more importantly, how can you avoid them? So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on the News Radio Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web with over 12,000 downloads. So make sure, if you're not a subscriber yet, to subscribe to us on any of your favorite social media channels, whether that's Facebook, YouTube, Spotify, iTunes, whatever the case may be. We're there. If you have trouble finding us, go to our website, nelsonfinancialplanning.com, and in the upper right-hand corner, you'll see a bunch of links. Click on them, and it'll get you directly over to that. My name is Joel Garris. I'm the host of the program. Also happen to be a certified financial planner and certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week. And maybe if you've been affected by that Disney layoff, you might have some financial questions that need to get answered. Well, we're here to help. We're here to help provide you some guidance, help you ultimately change your life with a successful financial plan that provides you with peace of mind for the future. So the choices we all make often have far-reaching implications, particularly when it comes to money, particularly when it comes to retirement. We're going to talk today about some of those things that can have a significant impact. There are some of the more common circumstances that people put themselves in that ultimately can result in you having a lot less fun in retirement. So we got 7 things to talk about, no particular order. Here we go. Number 1, skimping on savings. This is a function of understanding the difference between needs versus wants, right? There are things that we want and there are things that we need, and oftentimes we sort of mishmash those two. I need a fancy cup of coffee every morning that costs me $5. Well, you don't really need that, right? You could brew a cup at home and that would be, like a quarter. That's a want. And understand the difference and how interrelated we use the need versus want words. But the reality is that there's a pretty big difference between the two. And if you can start to really separate out what truly is a need, I have to pay my mortgage, I have to buy food, I have to pay my light bill. Those are needs. Wants, I want to go out to dinner, I want to go to the movies, I want my fancy cup of coffee. Those are wants. And so if you can start to really understand the difference between needs versus wants, then you can ultimately improve on your savings. So you're not skimping on them. Because as we saw during the course of COVID, not having an emergency savings account can really, really hurt, which I guess leads us to number 2 on this list, which is the other way in which we can sort of really hurt ourselves, is to have a high level of credit card debt. So when you run into a situation like COVID, where maybe all of a sudden your income stopped or was reduced, and you still maintain the same pattern of spending money the same way that you were before, you can often find yourself down the path of having credit card debt. Credit card debt, as you probably know, pretty high interest rates there, so no real big savings on interest rates with credit card debts. And the problem with that then becomes that it really is more of a slippery slope situation. So that you have a little credit card debt and you're not able to pay it all off in that particular month, and so consequently it rolls to the next. Okay, well, that's when the interest rate starts to click in, and so the next month, now you've got that prior debt and the interest from the prior debt, and now you have the new stuff that you put on the credit card. That can very quickly compound and send you rolling downhill to the point where you look up and all of a sudden you've got thousands of dollars of debt on your credit card. And because of the interest rates at 15, 18%, the monthly payment that you make is basically going to just cover the interest and never going to get paid down on the principal. So how do you avoid that? The answer there is budget. Keeping track of your expenses. Look, in today's world with technology and our phones and all that, you can absolutely keep track of how you are spending your money. There's no excuse for that. It's not like back in the day where you had to write it down with a pencil and a piece of paper because we didn't have, these computers in our pockets. We have computers in our pockets, so you can keep track of that pretty well. And so that's a great way to try and get on top of not just avoiding skipping on savings, but also avoiding credit card debt as well. Next up on the list, and of course this is a popular one since we help people an awful lot with making sure that they have the right investment allocation. All too often, people avoid the stock market. Are you doing this? Because if you are, then you're missing out on the potential for return, especially now with interest rates as low as they are. And we get it. We understand that fear, uncertainty, high. You can see that in cash levels. I mean, you don't need me to tell you that the election's, a month away, and this COVID stuff is still percolating out there, and that produces fear and uncertainty, and then folks stay out of the market. But if you avoid the market, the reality is that that's your best place for generating your best possible returns over time. The alternatives, cash, bonds, what have you, aren't even close in terms of the returns over time. The problem is if you put your assets in investments that don't have that much of a return over time, you're going to have to save a whole lot more to get the same result in retirement. We talked a little bit about this on a prior program. Let's say you got $100,000 and you're making 7% on it. Well, that $100,000 is going to turn into $200,000 in about 10 years. If it's making 1%, that $100,000 is going to turn into $200,000 in 72 years. So understand the problem, right? The answer is you've got to have that exposure to the stock market. That's where the best possible returns are over time. When you do that, we would counsel you to stay more on the large company side of things. Know the names that you own, big giant companies that produce the stuff that the world uses every day. We're going to take a break. When we come back, we're going to continue with the other 4 things that people do that can have a significant long-term impact on their finances. Coming up here on Dollars and Cents. We're talking on the program today about some of the things that people do that have significant long-term impact on their finances. In the last segment, we covered sort of the first 3, skimping on your savings, racking up credit card debt, and avoiding the stock market. Now we'll shift to sort of the back 4, if you will, equally important, no particular order. All of these are crucially important for you to be aware of so you don't fall into that trap. So anyway, welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network, along with 96.9 The Game. Also, one of the top 25 financial planning podcasts on the World Wide Web. So check us out there. Any of the various stations that you like to listen to, whether it's Spotify, iTunes, YouTube, or what have you, we are on it. Just simply search for Nelson Financial Planning. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So up next, and this is one that we see all too often, and this is a touchy one, but we're just going to come out and say it. Spoiling your kids. Spoiling your kids. And I don't mean, the little cute 5-6-year-olds. I'm talking about the 25-year-old sitting on the couch. The reality is that we as parents have a tendency to spoil our kids. Well, that tendency, if gone unchecked, is going to have a major impact on your finances. The reality is that if you look at those dollars that are going to your kids, particularly your adult kids, that's going to have a significant impact on your future retirement. Because remember, if the kids are adult kids and not, cute little 6, 7, 8-year-olds, the reality is that you're close to retirement. And if you're close to retirement and still throwing a bunch of money that way, that's going to be a problem. So watch out for that one. That was a tough one. That's a touchy one. I got 3 boys. We're all parents, okay? Or if we are parents, we all get it. We understand. But just understand that you've also got to keep an eye on that as well, because that can very quickly be a slippery slope that ultimately has a long-term impact on your retirement. Number 5 on our list, spending too much time at the dealership. And yes, we're talking about your favorite car dealership. Because the reality is, if you like your new car smell and you're getting a new car every 2 or 3 years, then you're ultimately sacrificing your future retirement picture. Because every time you buy a new car, right? I mean, when you drive it off the lot, it lost value. And so if you're constantly doing that every 2, 3, 4 years, then you're financially wasting a lot of money. And because you're doing that, that's going to have a significant impact on your future retirement. So watch out for that. If you're spending too much time at the car dealership, you got a problem, and that's going to have a haunting impact on your future retirement. Next up, along those same lines, buying a timeshare, right? I mean, that's probably not as bad as spending too much time at the car dealership, but the reality is we all like the idea of a vacation getaway, particularly this year, right? I mean, who wouldn't want a vacation getaway this year when we can't go anywhere? It's more than ever, there is a notion of that allure of having a timeshare in a beautiful vacation place that you can trade out. Well, here's the reality. Average price about $21,500 for a timeshare. Ongoing fees of about $1,000 a year that continue to go up. That becomes a big problem over time. Plus, it's nearly impossible to get rid of. So, just like you need to stay away from the new car lot, stay away from your favorite dealership. Similarly, stay away from your vacation timeshare pitch. I don't care what freebie they're giving you, stay away from that. And then lastly, not taking advantage of contributing to a retirement account, whether that's at work or individually, and in particular, not taking advantage of the tax savings that is an option when you do that. Whether you do the 401k, whether you do an IRA, the reality is that more often than not, most people will only be contributing to their 401k. If they are in fact contributing to the 401k, most people only contribute to the match. Well, that's all fine and dandy, and at the very least, you've got to do that. So, for example, if your employer is matching 4%, or 100% of the first 4%, or whatever the number is, then you've got to do at least that. The problem is that if you stop there, then you're not really fully taking advantage of the opportunity that you've got. If you're over 50, you can put like $26,000 into a 401k for the year 2020. So that's a pretty significant number. And if you're only doing 4%, that's probably just a few $1,000s. So you're not really fully taking advantage of that opportunity. Similarly, if you don't have a 401k at work, then you've got to go and establish an IRA. If you establish an IRA, then you can make contributions up to $7,000. And if you just don't bother with it, then again, you're missing out on the ability to fund your retirement and also get some tax savings on it. And then, of course, Speaking of tax savings, don't forget about the Roth option as well. That Roth option is usually one that we recommend for folks in lower income tax brackets, but in order to get the tax savings that comes from putting money in on a pre-tax basis into a 401k or an IRA. So there you go. There's the 7 things that you need to be aware of to make sure that you are not making a decision that's going to haunt you for the rest of your life. Here they are, 1 through 7. Skipping on savings, racking up credit card debt, avoiding the stock market, spoiling your kids. Ooh, that's a tough one, isn't it? Spending too much time at the dealership, buying a timeshare, not taking enough advantage of contributions and tax savings when it comes to retirement accounts. So be aware of those items. Double check, make sure you're not running into too many issues on those in your life. Otherwise, it'll be a rough retirement, that is for sure. We'll shift a little bit of gears here in this segment and talk a little bit about international investing. International investing these days certainly has had a tough run. It's one of the worst performing equity asset classes over the course of the past decade. And of late, it continues to kind of struggle. Our advice, be careful of throwing the baby out with the bathwater, so to speak. A little perspective here. When it comes to market capitalization, 55% of all market capitalization exists outside this country, only 45% in. So if you have exclusively a US-centric investment portfolio, then you're missing out on over half of what the equity opportunities are. I'm not saying by any stretch of imagination you should go to half in terms of your international allocation, but maybe 15, 20, 25, depending on, you have to have some exposure. One statistic that I thought was pretty interesting that sort of underlies that is that you may not realize it, but 3 of the 4 largest companies in the world, measured by revenue, are in fact companies that are headquartered in China. 3 of the 4 largest companies in the world, as measured by revenue, located in China. So still important to have that allocation. We wouldn't go overboard on it by any stretch of the imagination, but still good to have that in the portfolio. We'd stay more on the large company side of things like we always like to do. That's our bias. But make sure you've got at least some exposure there. We're going to take a break and continue the program after these messages here on Dollars and Cents. Welcome back to the program. We talked earlier in the program or on previous programs about some tax changes that we were anticipating, and one of the ones that has come to our attention is one that is focused on enforcement of activities relating to Bitcoin or similar cryptocurrencies that you need to know. We started this conversation on last week's program in this final segment, and we sort of ran out of time. So we want to make sure that we hit it properly here in this segment of the program. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris of Nelson Financial Planning. Our team of certified financial fiduciary stands ready this week to help you change your life with a successful, cost-effective plan that provides you with peace of mind for the future. So when it comes to your 2020 taxes, there's a change that the IRS has put on there, and it's pretty surprising when you stop and think about it, especially given where they have put this change, right under the name and address. So it's in a very conspicuous spot, probably the most conspicuous spot on your tax return, and it simply asks the question, at any time during 2020, did you sell, receive, send, exchange, or otherwise acquire any financial interest in any virtual currency? You must answer that question yes or no. That is the suggestion or the proposal that is on the table for being part of your 2020 tax return. Why would they do that? We think that there are 3 basic reasons why they would do that we talked about last week on the program. Number 1, they want their tax money. Number 2, when you sign the return, you sign it under penalty of perjury. So there's no getting out of it of, oh, I didn't really realize that, I didn't really know, all of that. And then number 3, it's actually an approach that they have used before that has worked pretty well. Back in 2009, they started asking people about offshore financial accounts. That alone has brought in nearly $12 billion to the IRS. So if you're doing anything with Bitcoin, cryptocurrency, or anything like that, the IRS absolutely wants to know and is really stepping up enforcement for the year 2020. So, because the reality is that, when a Bitcoin is roughly around $10,000 plus or minus, that's a whole lot of money that ultimately can generate some tax issues. The reality is that the IRS sees cryptocurrency as a potential threat to the tax system, whereby whether it's small-time enthusiasts or more damaging, sophisticated international criminals. Understand that non-traceable currency, Bitcoin, cryptocurrency of any kind, its appeal is it's non-traceable, and that's understandable. But if something is non-traceable, then who do you think is most inclined to want to use said form of currency? And it's not your, friendly neighbor Joe. It's, your friendly terrorist somewhere in the Middle East. So be aware of that. It's large numbers is what we're talking about. Coinbase, which is a leading crypto exchange, estimates that it had 35 million total accounts in the month of July. And if you look at the tax records, it looks like only about 150,000 tax returns actually showed any trading in cryptocurrency. So you got the leading crypto exchange, not the only exchange, but the leading one. The leading one has 35 million accounts and only 150,000 people report it. So you see part of the problem there. Much like the offshore account situation of 10 years ago, where they subpoenaed records and got information from various financial institutions that were multinational. Coinbase, similarly, as the world's leading crypto exchange, has also been subpoenaed and required by the federal courts to turn over ID information to the IRS. So this is a biggie, and if you are trading in that stuff, you better figure out what you need to do. Bottom line, if you've got it, you need to report it, and ultimately you do not want the IRS catching up with you after the fact on that one. Shifting gears, something else that we wanted to share with you was something that was brought to our attention thanks to a longtime client of ours, and it was a document that he got in the mail after he re-registered his house. He basically changed his deed, and anytime you do that, you have to file with the county that you've got a new deed. And so what happened after that is he went to his attorney, prepared a new deed, changed it over, put it over into his trust, and ultimately deed was filed. And then a couple weeks after that, he got this letter, and we'll hold it up for our YouTube audience. You can see we crossed out the names and addresses and stuff like that. But the reality is that it looks like a very official letter. It says at the top left corner, it is from the Property Records Office. Sounds legitimate until you see the comma LLC on at the end of it. So let's just stop right there for just a second. The LLC tells you that this ain't from the government, because the government doesn't have an LLC, right? I mean, it would have Office of the Government, not an LLC. This is clearly a business. What it says, and we'll just read it, Property Records Office. Again, giving you the illusion that this is from the Property Records Office. Seminole County records indicate that you have a recent deed transfer for a property located at address Altamont Springs. The deed has been recorded in official records and is the document that identifies you as the new property owner. To obtain a copy of your recorded deed, please attach to the bottom portion, return with a check or money order for $89. Okay. Don't do that. If you change your deed on your house and then proceed to get this letter where somebody wants you to pay money so that they can send you a copy of the deed, don't do that. Go to the internet. Go to the county property website, and you can print out the deed for yourself for free. So don't fall to this. The letter continues on. You will receive a copy of your recorded deed and a property profile where you can find the property address, legal description, parcel identification number, property history assessment, tax information, along with other pertinent information. Yeah, no kidding. It's on the website. It's on the internet. It's on the property appraiser's office, the tax collector's office. All of that information is public information. All they're doing is going online, clicking a few buttons, printing stuff out, and sending it to you in exchange for $89. Don't do that. They do, and actually is somewhat big print. See, it's right here on the thing, on the letter. Property Records Office operates in accordance with both business and professional code. Yeah, good for them, except they're charging $89 to print something off the internet. This is, you got to look deep for this. Here we go. This is a solicitation for the order of goods or services and not a bill. You are under no obligation to make payments on account of this offer unless you accept the offer. Do not accept the offer. Do not pay somebody $89 to go on the internet and print something out. Understand that this letter is getting generated anytime. Oh, and you got to respond by October 2nd. So, you got deadline. You got to do it. Send us the $89. Throw this one away, folks. It's not real. Ignore it. It's a waste of money. If you really want a copy of your deed, go on the internet and print one off yourself. It's not that hard. So, something to be aware of in terms of letters in the mail that you might get, particularly if you've gone and changed the registration on any property. With that, we'll wrap it up and get on out of here. Thanks for listening on to the program. We'll be back next week here on Dollars and Cents.